You set your stop loss. And the market goes straight for it. Not close, straight for it. It taps your exact price, stops you out, then turns around and runs the way you thought it would. Feels personal, right? Like somebody's watching your screen. Real talk. Nobody's watching you. But your stop loss? That thing matters to the market more than you think. And once you see why, this stops feeling like bad luck. Here's the part nobody explains. A market is basically a giant auction. Every single trade needs two people, one buying, one selling. No seller, no trade. A guy named Peter Steidelmayer mapped this out at the Chicago Board of Trade decades ago, and the idea still holds up. Price doesn't float around on its own. It moves because somebody agreed to a deal. Simple. But that one rule changes everything about how you read a chart. Now picture a big fund that wants to buy a huge amount of something, not $50 worth, millions. Here's their headache. There aren't enough sellers sitting at one price to fill that. If they just start buying, price runs away from them and every share costs more than the last. That's a terrible way to build a position. So they've got a problem to solve. They need sellers. A lot of them. In one place. Guess who's about to volunteer? Here's the uncomfortable part. Your stop loss isn't just a safety net. On a long position, it's a sell order. It's sitting in the order book, parked at a price, waiting for a reason to fire, and the market can see that resting order, not your name, not your account. Just the fact that sell orders are stacked at a certain level. To a big buyer, that's not a threat. That's exactly what they've been looking for. And stops don't land randomly. Think about where you put yours. Just under support. Just below the last swing low. A little under a round number because it felt safe. Now realize 100,000 other beginners did the exact same thing at the exact same spot. That's not a bunch of tiny orders anymore. That's a pool. A thick, obvious puddle of sell orders sitting in plain sight with a flashing sign on it. Researchers have studied this for years. Maureen O'Hara wrote a whole book on market microstructure showing how large players hunt for spots where they can fill size without wrecking their own price. So, when price gets pushed into that pool, thousands of stops fire at once. All those forced sell orders hit the market in one burst. And the big buyer? They're standing right there, quietly soaking it all up at a discount. So no, the market isn't out to get you. It's just going where the fuel is. Once that clicks, the chart stops looking random. Price isn't wandering from level to level. It's traveling from one pool of orders to the next. And that means those pools can be mapped before price ever gets there. This is education, not a crystal ball. But next, let's look at what a sweep actually looks like, candle by candle. Let's slow this down and watch it happen. A sweep almost always starts at a level everybody can see, a prior swing high, a swing low, two highs sitting at almost the exact same price. Nothing hidden, nothing fancy. The most obvious line on the chart. And that's the point. If you can see it, so can a few million other people. Which means everyone's stops are hiding behind the same door. Watch what happens when it swings open. Then price rips through it. One big candle, fast, clean, full of energy. And that candle does two jobs at once. It stops out everybody who was positioned against the move. And it convinces a fresh wave of breakout traders to jump in right at the highs. Your stickman is in there somewhere, clicking buy, heart pounding, thinking he finally caught one early. He feels smart for about 11 seconds. Then the candle stops climbing. Because here's the tell. Instead of running, price just stops. No follow-through. The candle grows a long, ugly wick. Volume pops out of nowhere, and all that momentum drains out in a heartbeat. Nothing above the level is holding. That stall is the first honest signal you get. A real breakout keeps pushing. This one hesitated. And hesitation at the extreme is where the story usually flips. Give it 1 or 2 candles. Within a candle or two, price snaps back through that level and closes on the side it came from. What's left behind is that long spike, the thing traders call a stop hunt wick or a swing failure. On a cartoon chart, it looks like a candle monster reaching up, grabbing a fistful of orders and yanking its arm back down. Everything above the line got taken. Nobody above the line got paid. And this pattern is old, really old. Richard Wyckoff was writing about this over 100 years ago. Different century, no computers, same behavior. He called the version at the top an upthrust and the version at the bottom a spring. Same idea both times. Push past the obvious line, scare the crowd out of their positions, then get moving. So this isn't some new trick invented by crypto whales. It's just what auctions have always done to crowded doorways. Volume helps you tell the two apart. A real breakout usually shows volume building and staying heavy in the direction it's going. Buyers keep showing up. A sweep looks different. You get one violent spike right at the extreme, then it dies. That's not fresh demand. That's a burst of panic getting absorbed by somebody who was waiting for it. Loud at the edge, quiet after. That's your clue. But there's one thing that beats volume. The candle close. That's the whole ball game. A wick tells you somebody got rejected up there. The close tells you who actually won the fight. If price closes back inside the old range, the sweep story is alive. If it closes outside and stays there, it's not a sweep, it's a trend, and arguing with it is expensive. So be patient. Let the candle finish. Now, about that 78% number people love throwing around. You've probably seen it. Some clip claims this setup wins 78% of the time, and the comments go wild. So let's be honest about where that number comes from. Backtests shared around quant and trading communities have shown swing failure patterns at bigger levels, landing in that 70 to 80% range under very specific conditions. Not always. Not everywhere. Conditions. And those conditions do all the heavy lifting. Condition 1. The level has to actually matter. A sweep of the daily high, the weekly low, something the whole market is watching, that carries weight. A sweep of some random wiggle on a 1-minute chart at 2 in the afternoon, that's just noise wearing a costume. Same pattern, totally different meaning. The shape isn't the edge. The location is. And most people copy the shape and ignore the location. Condition 2. Filters. A full candle close back inside the range, not a hopeful wick. The bigger trend pointing the same way. A supply or demand zone sitting right there agreeing with you. Stack those, and the numbers hold up a lot better than trading every spike you see. Strip them out, and you're basically flipping coins with extra steps. The filters aren't the boring part. They're the whole reason the pattern behaves. Now here's the honest part nobody clips. David Aronson wrote a book called Evidence-Based Technical Analysis, and his point was blunt. Most trading patterns fall apart the second you test them properly. Most of them. So treat every win rate you hear online as a claim, not a fact, including this one. Nothing here is a promise, and no setup wins every time. But there's a better question than how often you win. The question is expectancy. How much you win when you're right, compared to how much you lose when you're wrong. And this is where the sweep gets interesting, because the structure gives you a natural place to be wrong. Your stop tucks in just past the tip of the wick, small, defined. Meanwhile, the target sits way over on the other side of the range. Tight risk, roomy target. That's the actual appeal, and the math backs it up. Run the math, and it gets almost funny. If your reward is 2 to 1, you only need to be right about 34% of the time just to break even. 34. So a setup that's genuinely reliable, paired with 2 to 1, gives you a wide margin for being wrong. That's not a money machine. It's a cushion. And a cushion is worth more than a hot streak because it survives the days you misread everything. Mark Douglas said it best in Trading in the Zone. You don't need to know what happens on the next trade. You can't. Nobody can. What you need is something that works out across a long stretch of trades while you stay boring and consistent in the middle of it. That's the mindset shift. Stop hunting certainty. Start collecting repetitions. So, where do these setups actually show up? Let's go mark some levels. Grab your chart. Here's the starter kit. Mark yesterday's high and yesterday's low, then last week's high and low. Then look for any spots where 2 or more highs line up at almost the same price, or 2 lows do the same, on the 4-hour and the daily. That's it, 4 or 5 lines. Those levels are where the crowd keeps its orders parked, which makes them the most visited addresses on the whole chart. Equal highs and equal lows deserve extra attention. When a beginner sees 2 matching highs, his brain screams double top, strong resistance, easy short, so he sells right there and hides his stop just above. Now multiply that by everyone. What you get is a tight little stack of orders sitting in one narrow band, neat, obvious, and easy to reach. That's not support or resistance. That's a target, and sessions work the same way. If you watch Forex or crypto, pay attention to sessions. The Asian session usually builds a quiet, tight range overnight. Then London wakes up, or New York does, and one of the first things that happens is a poke through the top or bottom of that little range. It happens often enough that whole institutional order flow courses are built around it. Quiet range first, then somebody goes shopping in it. Round numbers pull the same trick. Bitcoin at a clean 1,000, a Forex pair sitting on a double zero. Nobody plans it, it just feels tidy, so that's where people set their orders. Daniel Kahneman wrote about this in Thinking, Fast, and Slow, Our Brains Anchor to Round, Easy Numbers Without Asking Why. So round levels quietly collect stops from thousands of people who all thought they were being original. Trend lines are sneaky ones. A line that's been touched 3 or 4 times feels almost sacred. Everybody's drawing it. Everybody's watching it. Which means everybody's protective orders are sitting right on the other side of it. So when a trend line breaks, then price climbs right back above it like nothing happened. That's one of the cleanest versions of this whole pattern. The break wasn't the message, the reclaim was. Now here's the good stuff. The strongest zones are the ones where these things pile on top of each other, a weekly low sitting just above a set of equal lows. Right around a round number. 3 reasons for orders to gather in one small pocket. That's not a level anymore, that's a magnet. When you're scanning your chart, you're not looking for lines, you're looking for places where the lines agree. Do this before the session starts, while you're calm and nothing's moving. Mark your zones, then close the laptop and let price come to you. That waiting part is the whole skill, and it's the part almost nobody does. Chasing candles across the screen is what burned your stickman last month. Sitting on your hands is what fixed it. Levels marked? Good. Now let's talk about what you actually do when price gets there. Step 1. Price has to actually take the liquidity. It needs to trade past your marked level and clear out the orders sitting there. And here's the hard part. You do nothing. You watch. Every instinct you have will scream, "Get in now." It's moving. That urge has cost more beginners more money than any bad indicator ever did. The sweep isn't your entry. The sweep is your alarm clock. Now wait for step 2. Step 2 is the reclaim. You want a candle to close back inside the range it just poked out of, not a wick that almost made it. A close. Which chart? Depends on the level. A daily high might deserve the 1 hour. A smaller intraday level might read better on the 15 or the 5. Bigger level, bigger time frame. When that candle closes back inside, the story finally has some proof behind it. Proof, but not permission yet. Step 3 is the shift. After a low gets swept, you want to see price break a small recent high. After a high gets swept, you want a small recent low taken out. Sounds tiny, but it's the market showing its hand. Before, sellers were making the rules. Now buyers just broke something they were defending. That's not a feeling, that's a footprint. And footprints are what you're following. Which brings you to the entry. Step 4. There are 2 flavors here. The aggressive one is entering right as that structure breaks, faster, but you pay a little more. The patient one is waiting for price to pull back into the gap or the block that the reversal left behind, and entering there. Tighter price, but sometimes it never comes back, and you watch it leave without you. Neither one is right. Pick the one you can actually follow. Your stop goes just past the tip of the sweep wick, a few ticks beyond the extreme, and that's it. Why there? Because if price trades back through that point, your whole reason for being in the trade is gone. The idea failed. Nothing to argue with, nothing to hope about. Moving that stop lower, because you feel strongly about it, isn't conviction. It's just paying extra to be wrong. So where are you aiming? First target, the other side of the range that just got swept. That's usually where the next batch of orders is resting. Second target, the next big pool beyond it. And taking something off at the first target does more for your head than your account, because a partial win keeps you calm enough to manage the rest properly. Half the game is staying steady while the trade is still breathing, but none of it matters without the last piece. Size. Keep the risk on any single setup small. A lot of traders cap it around 1% of the account. Van Tharp spent a whole book, Trade Your Way to Financial Freedom, showing that how much you risk matters more than how good your entries are. Perfect entries with reckless size still ends the same way. This is education, not advice, but it's the part that decides who's still here next year. And now for the hard part, you. Trap number 1. Jumping in before the sweep even happens. Price gets close, your finger gets itchy, and you enter early because it looks so obvious. Now you're not trading a setup, you're guessing. That's not analysis, that's fear of missing out wearing a nice outfit. The whole point of this idea is that the liquidity gets taken first. Skip that part, and you've thrown away the only edge you had. Trap 2. Calling a real breakout a sweep. Sometimes price breaks a level and just keeps going, closing higher and higher, and every candle is telling you plainly, this is a trend, not a trap. If you keep fading it because you're sure it has to come back, the market will keep taking your money in small, polite installments. The candle close is the referee. When it says trend, believe it. Losing to one hurts though. Trap 3. Getting swept out, then immediately swinging back at the market. Kahneman's work showed something rough about us. Losing hurts roughly twice as much as winning feels good. So after a stop out, your brain isn't looking for a setup. It's looking for revenge. That's when position sizes double and rules disappear. No shame in feeling it. Everybody does. Just don't let that feeling place the order. Trap 4. Hunting these on the 1-minute chart, at levels nobody cares about. Down there, the chart is mostly noise, and noise makes shapes that look exactly like the real thing. That's where the impressive statistics quietly fall apart, because those numbers came from big, meaningful levels, not from every squiggle at lunchtime. Fewer setups, better locations. That's the trade you're actually making. Trap 5. 2 losses in a row, and you toss the whole thing out. Here's the math nobody mentions. Even something that works most of the time will hand you 3 losers back to back on a regular basis. That's not the method breaking. That's just probability, doing normal probability things. Judging anything off 5 trades is like judging a movie off the trailer. You need a bigger sample. Livermore learned that the hard way. Jesse Livermore's story, in Reminiscences of a Stock Operator, still lands 100 years later. The man could read a market better than almost anyone alive. That's not what ruined him. What ruined him was not being able to sit still and follow his own rules. Read that twice. The hardest opponent you'll face isn't the market, and it isn't the big players. It's the guy holding the mouse. So here's the fix. Journal every one, the ones you take and the ones you skip. Screenshot the level, the reclaim, what you were thinking, and how it ended. It feels tedious for about a week. Then, somewhere around 50 examples, something changes. You start recognizing these live, without effort, because you've actually seen it happen instead of being told about it. Borrowed conviction breaks. Earned conviction sticks. If this changed how you look at a chart, hit subscribe and turn the notifications on. Next week, we're breaking down order blocks and fair value gaps, the 2 pieces that snap right into this and finish the picture. And drop a comment telling me what you trade. Forex, crypto, stocks, futures. Then share one sweep you spotted on your own charts this week. The people who talk in the comments sharpen up way faster than the ones who just watch. Before you click away, go open your charts and mark last week's high and low, plus any equal highs or lows on the daily. Then just watch those levels for the next 5 days. Don't trade them. Watch. Journal what happens, and count how many times this plays out the way we talked about. Seeing it live on your own screen will teach you more than any statistic ever could. The market leaves footprints. Now you know how to read them.